Hello, everyone, and welcome to the Attainment Podcast. Today, we're talking about the role of marketing in attracting VC and PE funding, which is a crucial task for every company throughout their early growth stage. And as our guest today, we have Brent Brookson. He is currently Director of Marketing at Texita Software, previously in product marketing at Amazon. I met Brent a few weeks ago at the Product Marketing Alliance Summit, where he was a speaker speaking on the dynamic between marketing and the company sales team, which is also very critical throughout a company's growth stages. And so without further ado, Brent, could you give the audience a bit of an intro about you and uh, as to what interests you in terms of the VC and P conversation? We actually had a very good conversation last week about this topic. And I thought, you know we should have recorded that conversation is what I thought. It was just so insightful. So I thought we have this conversation again and flush it out a little bit more and then share it with folks who are interested as a podcast episode. Brent, can you tell us a little bit about your history as a marketing lead and how you've been involved in influencing and impacting VC funding of the companies you work for?
Yeah, so absolutely. Thank you. And it's nice to talk to you again, David. We did have a good conversation last week and unfortunately did not record it, but here we are to try to repeat parts of it, but with maybe a little bit more structure with nice frameworks as we just discussed. I am Brent and thanks for the intro. I have about 15 years now, just over 15 years experience in the space, in the marketing world. I've worked everywhere from family businesses and startups to the megalith that is Amazon and everything in between. I've worked with PE firms, which I currently engage with on levels today, as well as VCs and in multiple VCs within startup and scale up experiences. And as well, obviously in the Alexa space with Amazon, the Alexa startup funds that also experimented with different companies to try to pull in some new innovative ideas, more startup kind of orientation and funding. So that's my general background and experience. I have some digital marketing experience, brand positioning, product marketing, of course, as I just spoke at the conference a couple weeks ago, and currently drive the digital and performance side on the Texana software marketing stack.
Fantastic. And as you mentioned, Brent, we'll put a bit of a structure here to this conversation to make it easy for people to follow along. So we'll structure it in terms of the stage that a company is at. That way, depending on what your stage is, what stage your company is in, the listener, you can tune into that particular segment or take notes or pay extra attention for that particular segment. So we'll go through the stages of a company. We'll start off discussing what the dynamic and the influence of marketing is like with potential investors at the early stage, then at the mid stage, and then finally at the mature growth stage, where we'll finish off by talking about marketing's role in an exit plan, IPO, and that's where we'll wrap it up. But to kick things off, Brent, at what stage should a company start looking to scale their marketing? Is it the early stage?
Yeah, it's a great question. I would say that scaling as a term, you should be trying to scale your marketing programs at any stage for your growth pattern. It just differs in where you focus. On the early stage, it's trying to scale the baseline programs. It's really trying to understand brand positioning, product market fit, all of those things that wrap into how to attract investors. Marketing, as anyone would know, even founder led organizations, the brand is the voice of the company. It's how people identify and connect with the product, make assumptions about what it is and what it does and what it's for, and make sure that they're connecting the dots. So from an investment perspective, where's the opportunity? How do I identify the gap in the market that this particular company is trying to fill? Doesn't necessarily have to be white space. It can be finding new innovative ways to address old problems. Uber, easy example there, right? Where taxi cabs have existed for a very long time, yet they found a way to leverage technology to improve the service. That brand story at the beginning, if I think of Uber specifically, it was the Uber black cars. It was the executive component. It was seen as a little bit more of a premium option. And we all know where it's manifested itself over the years. Those early investors were given that story and that's what they were buying into. And that very strong narrative kind of focuses on that competitive edge and how you scale that story within the space that you're operating. If you're a very unknown startup versus maybe a high PR value startup like a Tesla, or Elon already had a pretty significant ability to generate some PR value. But at any rate, you're trying to find that ability to put your story in more places and ensure that story as it's starting to unfold. Because in the early stage, chances are you don't really know 100% where that product market fit is going to land, or it starts, or where you're taking off from. But as that story changes over time and you find a better fit, that marketing team, usually a team of one or two at that stage, and even founder led again, can also spin that narrative pretty quickly. So having that scaling component or muscle, that early stage can also lend itself towards, efficiently communicating your story as it changes over time.
Gotcha. So early stage where you're still working on your product market fit, narrative sounds like is very important to establish a powerful narrative early on. Now, if you're a marketer coming into these early stage companies where they are working on their narrative, they are still that their branding is still very early stage. What are some things that you should focus on as a marketer coming into an early stage company? And what are some things that you should perhaps some pitfalls you should avoid?
The pitfalls to avoid is pretty easy. And I think the natural tendency for a lot of marketers, regardless if you're in the branding space or in the digital space, it's the marketing makes things pretty. And so you walk into usually a scrappy situation and they're leveraging anything they could get their hands on. They're typically not designers. So they're just building things from PowerPoint templates, trying their best to get it to the point that they think it's presentable. And your gut instinct is to spend all your time on that. And that you need to be the beautiful, best represented brand in the space first. When in reality, it's trying to make sure that your foundational elements are sound in order to then leverage and build that brand. So the first thing focus on is the metrics and tracking analytics and ensuring that your data foundation layer is set up optimally for where you are in that particular stage. Understanding, do you need a CRM database tool? Do you have one already? Do you not? What size of the market is it that you're going after? And what metrics drive your orientation around success? CAC and LTV tell stories that are maybe specific to certain types of businesses. They show scalability, which is an appeal to investors, is to see how you can take it from early stage where you are now and propel yourself forward quickly and capitalize on opportunities that you uncover. And that goes back to that branding positioning pivot where you may see an opening in the market or signal in the market that you capitalize on. It's easy to recreate that pitch, which can serve well for customers and as you pull in new business, but how do you scale that effectively once you uncover that opportunity? And so tools and all the marketing stack itself, like the tech stack, can help you there later in your growth stages. Early though, it's just could be something as simple as a spreadsheet with your trackable metrics that tell the right story, which is predictable results on a level that's commensurate with your current stage. So if you only have 3 or 4 customers and a group of 20 to go after, you're contained in that number. What are the things that you can attribute to success within that small data set? And yes, it'll be social media metrics. Yes, it'll be leads that you've addressed in a particular point in time, just as we would in a mature sales organization. But ensuring that data layer exists should be your key number one goal. Then move into the vanity metrics. What's my brand recall? What's my brand affinity? Things like that.
Gotcha. Okay. So establish the data layer and the key metrics that you can build on and feed into, let's say, the investor pitch. But as a product marketer, Brand, what about really focusing in on the product positioning, product narrative? Those things are still not fully defined yet at the early stage. So would you recommend also focusing there? Because I've seen many early stage businesses where the founders, they have an amazing product, They have a great vision of the product. But you go on their website, you try to figure out what is it that their product does. And even if you're tech savvy, like you and I, you can't quickly, easily understand it, what it is that they do and the value that they offer.
Yeah, it's a good point. I can think of a few different examples where the founding product was serving a particular niche, and that niche itself started to evolve over time as they actually filled the gap. And the product positioning relative to the investor pitch is powerful, as I say, in tandem with or in concert with the data that you can generate early stage. So that story that you're telling, yeah, there's the TAM and SAM and all the generic metrics that we would gauge as to, is this market big enough to serve based on the price index that we're saying this product is worth, or the value of the product. And that matters within the pitch. But if they don't understand specifically what, who it's serving and why, then it's going to be lost as far as the value. I would, yes, put product positioning, brand positioning, and company positioning as a high level goal early on, and definitely high in your priority list. But to go back to my point is, if the data layer doesn't exist to measure your efficacy or your ability to drive those stories to a good place, then you're not going to have an ability to adjust it to meet your goals. I might have a great story to tell an investor, and maybe it's positioned well and they understand it and they're willing to invest. But if I fail at that, I don't know where to turn unless I'm measuring by some consistent standard what pitch is working and which one is not. And I would say that in my experience, the customer is the one that drives the right positioning and narrative for the investor. And if the customer understands it the right way and you convey that to your investor and why that's really important for the market, they will understand connecting the dots from A to B.
Yep. Absolutely. I've seen many cases where the best positioning and description of the product and its value proposition comes from customers. You just listen to what customers are saying, and they will often describe your product and your value prop in a way that they will understand and that your investors will understand. Sticking to the early stage, Brent, this is a question that a lot of early stage founders have: is what type of marketer should be their first marketing hire? Should it be a product marketing specialist? Should it be a generalist? Should it be a digital marketer? Should it be a mid-level person, a very experienced and senior level person? Can you tell us your thoughts on that?
That's a great question, because I think even going back career wise, I would think I would make different decisions depending on where I am. So, I would have said mid range generalist is probably the best at that early stage. Later, though, it all maybe is dependent upon that particular person's appetite for effort. Senior people tend to come with bigger salaries and cost, which is usually the antithesis of the startup world and usually not feasible. So in the startup world, we tend to go with junior teams that have lower overhead, lower OTE expectations in general, and typically have a more hungry attitude to learning and doing new things and trying new things and leveraging innovative techniques to get the message across. I could think of lots of companies that are leveraging younger teams that are doing really well, leveraging social media, whereas older teams maybe haven't quite caught the TikTok wave like their younger compatriots. I would say that a generalist is first best because they understand the most about the broadest array of things. Product marketing can do a really good job at helping position the company and definitely the product. Where it may fall short for those that are experienced and specialists in that space is the digital performance and the social media component, and how to create from a creative perspective, the at best marketing creative that you can for the stage that you're in and the size of team that you have and the scale that you're able to achieve. And having someone that's able to do moderately well in a lot of different areas versus really well and one and not so well in others can be a disservice where you have a really good plan, but you can't execute. And if you can't execute, then you might as well have not built a plan. And so finding that person that can do media planning, that can do digital marketing, understands the generic website construction and how it works and what agencies might be able to help them or that they can leverage to help them achieve certain goals that they may not know themselves. And knowing their limitations is half the battle. So my advice would be try to get as senior as you can afford within your current expectations, but try to make sure that they're as well-rounded as you can find. And then as you start to scale out, you can add those specialist rules to propel yourself forward in the areas that you see yourself lacking, or where your original hires on the more general space just don't have as much horsepower.
Gotcha. Okay. One question I just had at the early stage, just an idea popped up. So at the early stage, you're trying to solidify your product marketing, you're starting to build your brand, starting to build out the metrics that you can deliver on. And also, of course, at the early stage, you're also doing a lot of persona work as well. What do you think of, just a random idea that popped up? What do you think of creating a persona for the investor along with your potential customers? Is that a crazy idea or is there something to that idea?
No, it's absolutely correct because you're creating assets. I think of SIM documents. I think of other pitch decks. I think of the storylines that you craft around new customer acquisition and logos that you've obtained and how that is framed towards the investor to keep them happy, maybe to get them to reinvest and double down on their investments, not back out or not want out is a key motivation. But really understanding their needs, wants, likes, their fears, motivations, knowing what their expectations are within, I'd say, the exercise of investment. Like, what are they trying to achieve? Yes, they're trying to achieve growth in their investment. That's an obvious, but depending on the makeup of that investor, it could be you're one piece of a bigger puzzle and they only have so much time to devote to you and track your growth and track your success. So they're hands off and they only really see your annual general updates and a SIM document update once or twice a year. So that's a very different narrative than someone who's on the board, actively involved, wants the ins and outs of your day-to-day operations, wants to see EBITDA growth, wants to see very specific metrics that to them mean something. And I'd say, yes, have a very clear persona group around your investment team and what their specific role is within the organization.
Fantastic. I haven't seen anyone do that, but if anyone wants to try that, it'll be very interesting to, to see how that plays out. Staying at the early stage, just because I know that the early stages where a lot of founders and marketers need the most help. One last question there is you mentioned agencies. Is early stage too early for agencies in most cases, or can that be justified in some cases?
It can definitely be justified. It depends on obviously budget, if you can afford to spend on the agency, but also strategic deployment. What are you trying to achieve? And in lots of ways, and even in current days, there's things you can do yourself and you can find a way to do it. There's a tool to help you that you may be able to buy on a subscription basis that is relatively plug and play or no code options so that people can get things done without having to be experts. But sometimes you need something super fast. You need to be able to get the upper echelon of quality in a time frame that you can't achieve internally. And that doesn't necessarily have to be like a make or break situation. If your website, for example, if you have a SaaS startup and your website is the conduit to your growth and it's not performing, and the team, again, if you've taken my advice and had a mid to senior level person that's a generalist, may not have the tool set to fix that problem in the time frame you need to either turn a profit or hit a certain revenue goal within the quarter or within the month if you have some big problem. And having that agility to leverage an agency at any stage means that you can solve some of those problems quickly. Might cost a little bit more, but the benefit may outweigh the cost right away. Fixing that lead funnel for a SaaS startup on their digital channels could make or break the company, and 20 to 30K with an agency might solve that problem and mean hundreds of thousands of dollars in AR or some other investment metric, revenue metric that they can justify to their board and justify to their management.
Gotcha. Good stuff. Now, segueing on to the mid stage. So in the early stage, you're limited with the metrics that you can present to your investors, as you said, because you might not have substantial revenue, for example. But by the mid stage, now you have steady revenue growth. You might be profitable now, etc. How do the metrics that you're tracking and focusing on change between the early stage and mid stage? Do they become more revenue focused, more profit focused?
Yeah. Depending on the company, when I've worked for quote unquote startups that have been startups for a decade. So they're maybe not really startups anymore, but time is one thing that you don't have on your side as far as the metrics and statistical relativity around success. If you've only been around a year or two, you're only really basing yourself off the last few quarters, or maybe 1 year over year metric that may or may not show a good or positive number. So once you get to the mid growth stage, if you've been around 3 or 4 years, you now have a little bit more statistical relativity or like normalcy, where it's quantitatively consistent and you can actually derive some real insight instead of basically reporting the weather. Like last year we did this and this year we did that, but I'm not really sure if that's just a seasonality issue. I don't know if that was a fluke. I don't know if potentially it was a couple customers that we landed in this month that we aren't going to have next year, because our market or specific niche doesn't support more customers at that level. So the metrics that start to shift are, you know, going from foundational metrics, you know, obviously general revenue and cost metrics to more, and I would say vanity, and people might thrash me for it, but more into the growth metrics, like what looks like potential exit positioning and how do we get the company to reflect the mature stage it's at, or the mid growth stage it's at. So that would be customer service led metrics. So quality scores and lead scores and customer scores, and it could be NPS. It could be a few different metrics that you're tracking to then showcase the longevity of your startup and the scalability or the effectiveness of your marketing programs relative to that scale. Am I driving the right message to the right people? Your website has been around for a couple of years now, so you have that data to show, yes, my positioning is resonating with the market because I can tell, I can see the positive benefit on my website, and I can see the conversion rate, consistency or growth. I can see my lead generation programs start to come to fruition. I can start to throttle up and throttle down my paid spend relative to my organic and direct channel performance to ensure that I have a good mix. So now I have a whole host of data that I'm starting to look at that starts to tell me if I'm doing the right thing. I might have activity data relative to my BDR or SDR programs. If I have that now, that then start to say, I'm reaching the right number of people. I have the right mix of programs running all concurrently to drive as much traction within the market space that I'm in. My pitch is working because I'm landing more deals. I'm getting more investors. I have more VCs floating around asking for investor pitches. My SIM document's getting better and better every year. My compound growth is looking better every year. And now I can start to report on my share of voice and my PR metrics and things that in the early stage aren't powerful because we're still scrappy in the early part in trying to just build revenue versus build brand, which is that mid stage. You're really trying to take the success of the early part, building that good product market fit and revenue model and business model, and pulling that into now a good brand that in and of itself can create value for investors and value to, again, looking at IPO down the road or looking at exits. And what are those companies looking for? Whether it's a competitor that might absorb you, whether it's out of market acquisition, looking for diversification in their company portfolio, or it's another PE or another VC firm that's looking to double down on a sure bet.
Gotcha. Good stuff. So you brought up brand now. Earlier, you cautioned at the early stage for marketers jumping into the brand building too early. But now I guess you're saying mid stage now you do want to go all in on brand building. Is that right? And the other part of that question is when it comes to brand, it's hard to measure. Are there some ways you can measure the value of building and express that to your investors, or do you just yeah, how do you communicate the value of the brand building, and how do investors look at that?
Then, yeah, it's a fully loaded question. I'll answer it backwards, like from the last thing you said to the first thing. So the easy metrics that anyone can measure for brand lift, at least brand awareness, is just looking at your I'll call it own channel metrics. How many followers do I have on the pages which I within social media, whatever handles you have, like whichever social media profiles you have, and what is my ability to get to that market through those channels, and how quickly or how slowly are they growing, and how many more people am I attracting to my channel, if you want to call it that. And that's one measurement. Brand search is another. So just generic, plain old school Google brand relevant searches. And how is that growing over time? And those two metrics alone, if I think about my social media reach and my brand search success, can dictate whether or not the things we're doing are working. And you can think of, especially on the B2B side, events are huge. And the brand lift from events is murky to be able to measure. You could do in-booth metrics. You can do CRM deep dives after the course of an event and say, look how many new MQLs, SQLs we generated because of these events. Those are great. And the assets you can deploy in the pre-event, during the event, post-event activities that have, obviously driving them to digital channels and tracking digital assets can still say, oh, this was successful. But you really want the equivalent of the billboard, the out of home advertising that would just generically ask the person walking by to be curious and go check you out. And without spending everything you've ever earned as a startup on a billboard, your next bet is to just measure that brand search over time through the event space and through your general activity. And direct channel can be a misnomer, but definitely the brand search increases will push you in that right direction. So digging a little bit to your earlier part of the question, I would say in the early stage, brand is important, but only in the vanity look and feel. So you want to make sure that any logos, any brand colors or brand guidelines are pretty consistent so that you don't have one end of the company positioning it one way and the other end of the company positioning completely differently to the same customer. Minimal attention on the brand to make sure that it's consistent. When you move into the mid to late stage, that's when it starts to get into the brand building, which is, in my view, regardless of the market you're in, and I'm in the heavy equipment space now, it's trying to build goodwill within the space that you exist in. And what I mean by goodwill is that your brand is associated with positivity and growth in the space. And everything that you can do in your mid stage journey is trying to build that up. And so that's where your campaigns that drive through awards in the particular space, whether it's your own company, think of like Deloitte Fast 50 or some other notoriety driven vanity metric or vanity award that shows people you have standing in the community that you're in or the market that you're in. I'd say Deloitte gives you a pretty firm, we're financially sound and we're on the right trajectory. But there's others that can also lend to that. Some are much higher play, like a JD that may not play to you, but there's still more. You can do it to your own customers. You can provide your customers with awards for being great at their own space in their own right, and try to drive, what does your brand really mean for the growth or success of the customers that use the tool, use the product that you've sold them, and how are you fueling their success over time? And that is how I would say the importance of the brand in the mid stage can start to drive revenue goals because you're setting yourself apart or differentiating more so than just on feature, right? Product differentiation on features and product positioning can work to a degree, and then someone else could just replicate your feature. Especially if you're talking software, it's very easy to replicate, but they can't replicate the the community that you've built around your brand and how your brand is distinguished between others. Now, I wouldn't say you spend a lot of time and energy and money relative to other programs, but it's definitely, I would say, a higher priority than it would be in the early stage.
Gotcha. Good stuff. And I think at this stage, the investors, do they expect you to start doing some brand building? They're generally expecting it. No?
It's an interesting question because I think if you ask two different investors, they might give you very widely different answers. I would say that the brand building question from an investor perspective is how much is it going to cost? And is it a capital outlay, which in some cases it may be? Is it just a resource allocation? So we only have so many team members that are driving towards revenue goals. How much time can they really spend going to toy drives and doing video cuts of them at charity events or whatever regional events or something that you're trying to drive towards your brand building? I would say that you're trying to position that. And this is again, maybe back to the investor story or the investor pitch into your persona, which is still a good idea, is what are they looking for in that vision? It's they need to show that, or they need you to show that the brand itself has value and that when it's positioned for exit, acquisition, IPO down the line, that it's not just the channel. It's not just the ARR or the book of business or the thing that they're actually offloading. You can increase the value just by having a good brand presence, and revenue targets and revenue goals are definitely part of that equation. But if you look at a lot of acquisitions and IPOs, the companies that were very successful didn't even make any money. And they still continue to lose money despite the influx of cash and IPO. And maybe it took them another 6 to 8 years to even turn a profit. So the user base matters. Obviously the number of accounts you have, the ARR or the whatever revenue model you're working with definitely plays into that value of the company. The people and the knowledge within this company matter and how continuity of that company matters and has value. But the brand does have some weight. It has less weight in certain markets. It has less weight with certain business models, but it has value. And if you're trying to increase that visibility for the investor.
Gotcha. And sounds like there is in most cases, the expectation of brand building, but also the
Yes.
expectation of not overdoing it. And because if they overinvest in brand, then perhaps that might be a risk. And speaking of risks, what what risks do investors often see that marketers can help alleviate? And I guess this we can also just take a step back to the early stage, going from early stage to mid stage. What sorts of things have you done to de-risk? And then and then once you're at mid stage, trying to go to the next stage, what further things are you doing to de-risk?
This is a great question. So then what I've done, so my background, again, looking through the VC led startups to PE backed or PE invested companies, it's no different than looking at what does a retail investor want, right? Like a savvy retail investor. I don't want to say like the average person, but someone that is looking at some financial ratios, balance sheets, and trying to look at the income statement and say, oh, this is a company that has a good debt to equity ratio. We're actually showcasing some stability in their cash flow and those are important things for any investor to see, that their money is safe. There's the risk of losing all of the money that you invested. There's also risk of just not making as much. So there's kind of two ways to look at it. I would say that myself personally is trying to, again, drive to that data foundation that proves the scalability and growth and demand of the product of the company. Having that data to showcase growth, ups and downs, if it undulates. Not every company is perfect every single quarter. You miss some, you have bad quarters, but showing that consistent growth and showing where that growth is coming from, improving the demand and market for the product and the company is the best de-risking agent you can provide. Sales revenue numbers mean something, but those are snapshots. So if I said to you, what is just perfect, because I come from a sales background as well as like you have some sales background. Sales is the age old. You have a great month, and then the very first day of the next month is, what did you do for me lately? And sales has that problem that it's only as good as the number in which you reported on. Whatever happens going forward hasn't happened yet. Marketing can at least give you that predictability that showcases something like lead generation. If I show predictable models that suggest that for the next 6, 12, 18, 24 months, our rate of progress or rate of growth is showing this percentage over time, then it's at least predictable to say, or safe to say, that it will continue. And those numbers tend to generate the revenue coming down the funnel. So if I'm predicting or getting into a better predictive position on the top of funnel and mid funnel, the bottom of funnel becomes a lot more realistic. And the sales teams then have more confidence, but then the investment teams, VC at the board level, also has confidence that those numbers have teeth, which in the startup world, in the VC world, it's very common that some of those projections are very bloated and based on big assumptions. And so marketing has a huge role in de-risking those assumptions and making them less assumptions and more realistic, predictable future projections.
Gotcha. And just on that note, in terms of de-risking, minimizing risk, and maximizing ROI, marketing ROI, MROI, as some people call it. In early stage, you said one potential high risk marketing spend would be brand. Might be a little bit too early for that. At mid stage, what are the risky marketing investments that marketing leads should be cautious of? Is it going out there sponsoring events and doing too much PR? So in terms of optimizing your marketing ROI and then minimizing the risk of doing big marketing spends and not having anything to show for it, what areas would you caution marketers?
Yeah, I think the event space is one to focus on, to just carefully project your success metrics and know what your investment is going to turn. It's very easy to spend a lot of money at events. The event industry itself is very good at wringing as much money out of businesses as possible, whether it's renting TVs or booth space, everything is for sale. It's also very easy to get out of control and not track properly and get in the habit of going because you went last year without real tangible reasons why. Now, being absent is usually not good either. No one really wants to not be present in the space in which all of their customers, competitors are. But it's also just being realistic with where you are specifically in your marketing journey or your company journey, and where you best fit within those events to get the most ROI out of it. Because you're still likely in a very heavy lead generation journey where you're trying to still build the mechanisms and find new opportunities for growth within the channels that you've now hopefully materialized some historical data and are tracking towards a pretty sophisticated plan instead of a loosey goosey roll with the punches early stage plan. Now it's, you have targets and hopefully OKRs or some other framework of goals around the spend and around the objectives and achievements that you hope to generate in any given year or period. But the events are the one that can get away from you very quickly. The other is paid spend. And so in the early stage, people tend not to spend a ton on any sort of digital channel growth. In the mid stage, because now you've generated some revenue, you have some success, you have some track record, people tend to want to then spend some money in the paid area and get the easy wins or low hanging fruit. And you can do that, but you definitely have to focus on the efficacy of your campaign and very quickly cut the losers and discard and make sure that you're doubling down on the winners and diversifying and experimenting as much as you can, but keeping yourself in your control windows. I can't speak to anything specifics, but recent examples within the space that I'm in saw some pretty significant jumps in the paid spend unannounced, which completely obliterated budgets for the rest of the year and reined in controls that otherwise would not have occurred if you had been paying attention, right? And that in and of itself can ruin an entire budget, can ruin an entire plan if you're not paying attention. And paid is only a channel, and it should be, in my view, at that stage, used as a safety valve. So if your organic and direct channels are suffering, or you had an SEO setback because of some algo change, you can rely on the paid channel to shore you up while you build those mechanisms back up with your content plans and your SEO plans and in general, your activity, so that you can just push that back again and pull the throttle down a little and not be so heavily reliant upon paid.
Gotcha. And what about the team at this stage? Mid stage, you've done your Series A, you're working on a Series B or Series C, et cetera. And how do you set up your team at this stage for success in terms of raising subsequent stages? What, for example, are the one of the highest priority marketing hires at this stage? Early on, we said it's a generalist. What do you want to start adding to your team at this stage? And what are the hires that, again, are high ROI, minimal risk?
This is a modern issue across the board. I think for any company, startup or not, VC backed, PE backed or not, is the next, I'd say, biggest hire is, or two areas. One is data and analytics, and we'll call it, balance that with a RevOps slash CRM focused hire with a content hire. And you will maybe get some cross benefit on the content side with social media managers and other people that can drive some of those platforms for you. But the back end analytics and the content generation are key. One, because you need to be able to track the efficacy of your content plan and how it's producing the results that you need for the company. But that content needs to be diverse. It needs to be produced well, quickly, and needs to come with a level of creativity and agility that you can't get with the generalists. That hire needs to be very focused on generating real content that drives results.
Gotcha.
That's not easy to find.
Yeah, absolutely. And because I think investors also look at the company's content as well, right? Like, look into their content, read their content, watch their videos, etc. So of course, there's the content that makes an impact in terms of customer acquisition, brand building, demand gen. Um, what type of content has the biggest impression on investors? Would it be customer case studies? Would it be, yeah, just your thoughts on that.
Yeah. And I guess even adding to that, because you mentioned is the demand gen is I'd say the primary team focus at
Okay.
the mid stage. And that can take many forms, right? So a lot of demand gen leaders can be content generators. But yes, I would say demand gen, content analytics, basically creating the ability to scale your now mature marketing machine and take it to levels that your one or two or three generalists can't do. Um, and then getting back to the question of the content that investors want to see, I think case studies, customer references, anything that's giving viability to the demand of the product and market and showing that product market fit is valuable. The medium itself, like I would say, is It could be dependent upon the makeup of the investor, their demographic, their age, what they're seeing in market. Anything that's highly visible, that is shareable, and that people are typically expecting. Moving the organization towards a modern media generation as far as content is paramount because it shows you're with the times, if you want to call it that. I'm not the youngest, I'm not old, but I'm not the youngest kid on the block. Ensuring that you are keeping with the times and maximizing your opportunity with new channels. I could think of many companies that you wouldn't expect to be on the TikTok wagon, but they're on it and they're successful. I don't want to call it the Stanley example of the whole fire in the car thing. That's one example of just capitalizing on something within market and having the team in place to be able to do that. Investors do want to see that you are looking around corners and trying to find opportunity to, again, differentiate or distinguish the brand. Content is just one of those avenues where you can differentiate and build value on the brand through the mediums and media that you create.
Gotcha. Also at this stage, just going back to the team build up, the team build and the team dynamic, what do you think about? Because when you're on a marketing team or you're leading a marketing team, you're talking about your marketing objectives. But what about talking about your marketing objectives in terms of not only do we want to generate revenue and pipeline, but hey, we also want to set ourselves up to attract investment in future rounds. How can you, do you think that's a good idea to bring that into the marketing team, that objective, and keeping that top of mind? And if so, how would you align the team on staying aligned with the broader business goals and the company's ambitions to keep growing, keep raising subsequent funds and get to that later growth stage?
Yeah, it's a balancing act because there is an interesting dichotomy between building for longevity, which is what typically companies do and what teams do. They build for forever, assuming that whatever is happening today will be happening forever. Might take a different form and look a little different. You're drinking Coke Zero. I'm sure the team at Coca-Cola at 1972 working on the brand, those that are still around today would be like, oh yeah, the brand's still there and it's still doing its thing. It's a different form. It's still there. In the startup scale up world, the brand could be completely different in an acquisition or IPO situation. It could be absorbed by the acquirer and be called something totally different. And so building to something that just gets eradicated feels a little demotivating, like not really that appealing to a lot of people in the marketing space. So balancing that with the overall goals is tricky, but I think still I'm data driven. So it's trying to focus on the metrics that build success within the marketing platform and the marketing program that also lend itself towards preparation for the investor to either invest and put more money towards the company or to get the money out in the case of an acquisition or an IPO exit or something. And things like brand strength, which again, based on the metrics that I talked about earlier, could specifically just be those things like look at our growth trajectory in the brand space that we operate in. Could be market share, right? Where are we sitting within our competitor space? Where are we sitting within the overall market? And how does that translate to our goals as a marketing team and how we go and get more market share, more brand share, more share of voice? And then customer loyalty is another that you can focus on, driving that, case study narrative or user generated content if you're good enough to get your customers talking about the brand in a way that you could never project yourself with any sort of credibility. And that is a strategic level thing that investors will look for, is to see that the brand strength or brand value, the market share, which just brings yourself to the position that you're in within the market, the loyalty or strength of the customer. So obviously churn rates and your ARR growth rates and all those things all matter towards generating that consistent revenue, which obviously buyers want, but it showcases stability if that customer rating is high. So if you're getting NPS scores or some similar consistent metric across your customer base is showing that you have stability. Partnerships and co-marketing are another area that I haven't even touched on that can also lend itself towards credibility and value in market and showcasing that the brand or the company has a seat at the table, so to speak, to drive the narrative within the market that it serves. That has value into itself because in some cases, some investors may want access to those partners or access to those co-marketing campaigns that could also benefit their brands and their products. It just shows just a general narrative that there's a prize, and the prize is, you know, the company's healthy, the company is well positioned, the company has the mechanisms within it to drive growth and scaled growth and predictable growth, and it has stability. And marketing can all contribute to that. One in literal practice, like just performing their function, and also pulling that into the investor narrative. So maybe even if you get to the mid to the mature stage, you may have a customer success team that's fueling the marketing team with all of this data that's showcasing the value of the customer base, as well as showing the prospect or new logo component or new business side. Customers so happy and successful that they need to get in on the action, which again, to the investor shows stability across the revenue generation model.
Gotcha. Fantastic. And you mentioned co-marketing, Brent, and it just occurred to me that these VCs often have a portfolio of many related companies. Like if they're investing in you as a SaaS company in fitness, they probably have a few others in that space. Do they like, and do they want to see some co-marketing between the companies in their portfolio? Is that a thing?
Not, I'm
Could it
sure it
be?
exists, just not. Yeah, and just that to a high degree, because the two things typically would happen is that you're spreading risk in the investment across the same investment, which
Okay.
may not be the greatest idea. It can work though. Like if the companies are complementary to another, then it would make sense to share the burden of investment on the marketing investment. If we assume that the customers they're both serving will generate revenue for each company independently, and that it's not just benefiting one or the other. Or maybe that's the case that one is just well positioned and the other may not be. Hard to say, but it's an interesting question. I would think that myself personally would just be looking at the risk associated with the failure of the co-marketing venture and what that means for both companies as it pertains to my investment.
Yeah, that makes sense. Multiplying with risk just increases the risk multiples. Okay. Interesting. And at this stage, do you think we're ready for PR, or does that come more toward the late growth stage?
No, I think PR is still in the mid. It can also be leveraged quite well in the early stage because the cost relative to the benefit can be outweighed up with just normal PR channels, like not even trying to amplify, just literally putting your name out there and getting some SEO benefit out of a URL being attached to the Associated Press. Like it's not a lot, but it's something. And it's even if you put it on your website in your news and announcements section and it's legitimate PR instead of fake PR put on a page that didn't go into the APA or it didn't go through the wire and it just looks a little bit less legitimate. There's value in the early stage, mid stage. Absolutely. You should be driving some sort of PR narrative, not only because you want to outshine your competition, but you want to build the story that investor can get behind. And whether that's strategic partnerships that add brand value or it's product announcements that add differentiation in the space, it means that that investor can stitch that story together themselves. And as the marketing team, you can leverage those growth channels, like a PR growth channel is saying, look at all, just think of pickups or something normal that we would report on. You just look at the growth rates of said activity, it still has value. And associating yourself with different brands, again, and product differentiation or company differentiation to build a brand narrative is a pretty important component. And again, it's not the traditional brand build, which is spend millions of dollars on TV ads and maybe YouTube and trying to be a media production company, but doing enough that you can generate credibility.
Gotcha. And I would think that really helps attract more investors. Investors seeing your story all over the press, all over in different publications. That's a real good.
Mhm.
That's a really good look in front of investors, and especially if you can make it to like a Financial Times kind of newspaper where investors are reading, you might get discovered by more investors to those publications. But
The PR comes in I don't want to just earmark it to like press releases. A pure PR strategy is trying to find opportunities for any media to jump on and amplify your story. So there's even a full-fledged PR strategy can be centered around getting lots of different organizations. It doesn't necessarily have to be media to pick up your story and to talk about you in a way that, their audience or just increasing your general reach will help pull people into your environment, in your orbit, so that you can then leverage your machinery that you built to then pull them into your actual funnel and start to pull them, whether that's an investor funnel, because hopefully you have now your business development team, corp dev team, trying to pull in people from different areas and different avenues, but all of the people within the spaces that they're operating in, maybe it's associations, right? Coming from technology companies, there's a lot of trade associations that they're involved in that you want to be known in and have the space in, and maybe have press releases and maybe have them share your media and the things that you've produced within their audience so that you could benefit from that reach that you don't have.
gotcha. And of course, there's also using your funding rounds as PR itself to create more buzz and create more hype. Like previous companies I worked at, our best times in terms of website traffic and search it and branded searches was when we did funding rounds. So would you encourage companies to really leverage those funding rounds to spread hype, create buzz?
Absolutely. If you think about depending on the nature of the funding round and the number of participants, you could be naming significant companies and PE investment firms, VC firms that also have huge portfolios of companies that are paying attention to them. It increases the value of the overall brand of the company that they're invested. If there's anything that shows the market, I'm saying in general, that there's confidence and faith in a company, it's people investing in it. And so if you leverage that to your benefit, I would say, I mean, depending on your audience and depending on your market that you're serving, it should be prominent on your website. It should be prominent in your communications within and around the funding round and when it occurs. And if you are prepping for IPO or anything that's of significance, you are leading up to that PR bubble that's going to showcase that bigger light versus just bang and it's done. You're going to have a lead up, and seeding those stories is part of the battle in the PR world. But even a smaller team can make big things happen with a good PR strategy.
Super. And you mentioned IPOs. Moving on to, so I want to talk more about IPO. And so let's move on to the mature growth stage where you're starting to eye the IPO. Now, you mentioned to me, Brent, that so far we've been talking about VCs, venture capitalists. Let's talk about PEs, private equity. And I think they come in more so at the mature growth stage. What sorts of things are they looking at that are different from what a VC would look for?
It's a very good question. The I would say that for the most part, PE firms are looking for those predictability factors. I think that my experience has shown VCs again are taking more risk on unknowns, which are big bets based on vision, which is going back to that original component of brand positioning and good product positioning and product market fit, and trying to make sure that investor pitch is grounded in how am I going to change the market? How am I going to fit within the market and fill the gap? And this gap is worth X. And here's how I'm differentiating. Here's how. And then you get to mid stage and you build the engine from the marketing side to go get the business that you've now zeroed in on or solidified that you have that fit. Where PE firms are typically trying to drive or find firms with measurable growth and efficiency within their processes. And those revenue driven strategies, tying marketing to sales, like the outputs have to be aligned in saying the revenue goal is this, and the marketing apparatus is now driving towards that goal and it supports that goal. It may not be driving it completely, but its whole foundational focus is driving that revenue forward. Data driven, you're coming from the Amazon space as well, which is purely data driven. Every program that companies at that later stage that have either want to draw PE investment or already have it and want to facilitate more or position well need to have that data driven foundation. So if you've built it in the early stage and you've pulled it through your entire existence, you're in a very good position to showcase to those firms exactly how you have this predictable model showing your growth pattern. And it's believable, it's reportable, and they can track it over time. And that's a very big motivator. The other, I say, foundational piece is you have programs that are addressing very explicitly and deliberately to pull new business in and drive revenues to your existing customer base, and how those strategies tie together in the overall revenue plan. And those are very distinct, different strategies, and they need to be, again, built on predictable models of success. Frameworks we talked about it earlier today. The frameworks themselves, it's calculated investment in the marketing stack, like the tech stack, to get the results that you want. It's repeatable processes, not having to reinvent the wheel every time you throw a campaign out the door. Like, it has to be not templatized, but it definitely needs to be in a position where the muscle that you've built is where you can look at an opportunity and just flex and it's out the door. And it's at the same level and quality that you would expect if you had months to plan it. Now, it might be scrappy and the ideas might be built a little bit rough around the edges, but the actual apparatus to generate the content, to generate the campaign and push it out the door is very easily repeatable and predictable. And it just grounds itself in, I'd say, like a modern integrated marketing stack that is easily, add a new team member, they can easily jump on the team and start to produce right away because those tools are there to facilitate that. Yeah, that's the foundation, I think, for the PE firm. Like, that's what they're looking for. Proficiency in your campaign performance and reporting, channel diversification, ensuring that you are maximizing opportunities in every channel that you have available to you. Again, looking around corners and ensuring that there's not unturned stones or any opportunities that you could capitalize on and then use that machinery that you built to execute. Agility and flexibility, really, again, going back to that muscle. If you see an opportunity, if you're able to adapt to signals in the market, even at a later stage, your product might still shift. And maybe it's not in pure product. Maybe it's ICP expansion. Maybe it's you're now building a piece of the product that now serves a whole new market that you weren't already for the last 20 years trying to build business with them. And now that marketing engine needs to turn its attention on a completely new market area and just basically spool up that opportunity within the existing frameworks and predictable reporting structure to showcase one success, but also be able to help contribute to the goal set. Now that the marketing team has this nice predictable engine, if I pointed at this, what's going to happen? What's your best guess? And those guesses get more refined as those teams become better at executing, leveraging those programs. And I'll cut you off before you even ask the question, but the marketing hires at this particular point is now you want seasoned senior people to drive those things to fruition. It's people that are looking 30,000, 100,000 feet above and looking down, looking at the entire landscape, trying to see opportunity to improve and modernize and mature specific processes. And maybe it's elevating the team or upskilling particular people, or it's really honing in on something that's working and trying to build that cross-functional team to pull in all of the expertise from around the organization to fuel your growth. And building that strategic vision, it's a 3 to 5 to 6, maybe 7 year outlook that then builds that predictability that the PE firm needs to look at exit possibilities and say, again, if I go from the mid to the late stage, the exit opportunities exist, or I guess they're across the board. You can get acquired a month after you incorporate, but the likelihood is going to increase over time as you build your brand and build your company. So that strategic vision looking 5 to 7 years is also their ticket or their vision to understand what their potential investment will look like. Because now the multiples become easier to calculate. So if you look at, again, a SaaS company, your ARR growth is now much more predictable, especially as you get to a refined marketing program that ties to your revenue goals. Because then those revenue goals typically have a pretty standard growth trajectory. And so if you start hitting those goals and that trajectory becomes a lot more credible, then they can start to calculate the returns and start to think through their own strategy when it comes to start to positioning themselves for those exit plans. And when is the optimal time to start to think about an exit? And what does the team makeup need to be at that particular time? What product do we have to have in play in order to make that the most attractive and feasible? What is the customer success score? What is the revenue attainment level? What's the optimal size of the team? There's all big questions that, we can help as senior leaders at that level in the marketing space to start to build that predictability through marketing.
Gotcha. And yeah, that was going to be my next question as to what is the team makeup at this stage. But it sounds like you want to make sure you're building a finely tuned marketing engine, add a marketing operations manager director, and have a really fine tuned CRM practice, and then to drive those upsells and cross sells with their existing customer base and maintain high customer satisfaction. Maybe add a customer marketing team as well, and then to signal that this engine that you built is going to be around for a while. Add that senior leadership, that CMO perhaps, to signal to these investors that, hey, this marketing system that we build is going to be around for the next 3 to 5 years.
Exactly. And there's nuances there. A marketing team can still coexist cross-functionally with other people in the org. So your customer success team and your sales team and your rev ops team and maybe their support team. Like there's lots of different people within the org that can help contribute to your marketing goal without that being within your team. I'd say that driving an ABM approach where it makes sense, especially in uh, a high touch B2B SaaS organization, ensuring that you have the right people in place to build and drive that type of program, which again comes through dynamic content. It's personalized, which means you need a good RevOps team and you need a good content person and a good demand gen team to try to pull those threads all the way through so that you are an opportunity to drive some of the cross-sell and upsell opportunities, drive some customer retainment or customer programs to reduce churn and increase cross-sell and upsell at the same time, or to address some of the, we'll call it feedback loop mechanisms that can drive some product discussion and drive success stories through that and have the ability to harness now a bigger team to build the assets you need as a maybe smaller, because marketing teams tend to still be small, 10 or less, to really drive through, the scale that you need to attract the revenue levels that are required to grow as you move into the highly mature stage.
Fantastic. And one of the nice things that being a marketer at this stage is that you are often looking ahead at IPO. The company is starting, the leadership is starting to talk about IPO. Maybe you've been given some stock options, some equity, and this in anticipation of the IPO within a year or two. So yeah, at this stage, I think a lot of marketers in the earlier stages you mentioned, you don't want you don't want to emphasize the further funding rounds too much because you don't want your team to be short-sighted. But at this stage, is it okay to start openly talking about IPO with your marketing team and how we might contribute to it since we all have probably stock options at this point?
Yeah, I think I haven't had the experience myself of being in an IPO situation internally, but I can imagine that a lot of the mechanisms that go into play with that phase, a lot of the teams are charged with building out due diligence. And from my own experience in a due diligence situation, I can tell you that the marketing program had a very big magnifying glass on it. And looking through the revenue models and looking through the marketing plans and attainment levels and success was a pretty big component of the due diligence. And you'd be amiss to try to shield your team from that. I think that part of the exit strategy or IPO strategy at that level is it's the GTM plan. It puts your company in a different trajectory. And especially with a lucrative IPO, it could mean worldwide expansion, depending on the size. So I'd say, if I'm thinking the PE side and VC, but it's align your marketing engine to the GTM plan, which is aligning to the sales plan that talked about before, but it's what is the mechanism that you're pulling your efforts through to match the direction in which the company's headed. And at that level, IPO being one potential path means that there's, in the case of the US, there's VC things and filings you have to think about. There's data protection issues you have to think about. That again, marketing has a huge influence in how well or how poorly we adhere to some data privacy issues, whether that's from a generic outbound, our website collects this and does not collect that, or we regularly send emails to lists we shouldn't. There's lots of things you can do to curtail some of those privacy issues. But really, it's making sure that your marketing mix, your marketing engine is commensurate with that level. So your sophistication should be very high. So instead of broad market, it's narrow channel, it's ABM, persona driven. It's very focused campaigns on maybe product level campaigns. Maybe it's vertical specific. If it's horizontal campaigns, it's use case specific or user specific. And then the marketing plans are channel specific. Which channels are driving the most value for the company, not only in attainment of new business, but in brand build and in differentiation in market and value. And so that IPO looks NPR and that IPO looks that much more attractive to retail because they've heard about you, they can see the value, and they understand your growth trajectory. And they can see that you're sophisticated, that you're focused, and that the path you need to take. And the polar opposite is the startup, where they're long westing it. They have really no idea who their ICP is. They're still figuring it out. The product market fit is just fluid, and they could be a software company one day and a hardware company the next. And it all depends on which is the biggest fish that they can catch. And that's going to drive the most revenue. That's the company they're going to be. Whereas on the other end, you've already done all that. You've grown up. And now you have to figure out how to move out of the house.
Gotcha. Those are some good tips for, I think, marketers for these companies and who have been given some stock options and want to help their companies IPO successfully and as soon as possible. These are some great tips. And I think the due diligence part was interesting in that you want to make sure that you're building out and developing your marketing function to be ready for that due diligence.
Yeah. And sometimes depending on the, say, sophistication of the acquisition or the acquirer, like that checklist could be quite deep. In the case of the experience that I've had, it was very deep. And the questions are pointed and they're pointed for specific reasons. It's about understanding and uncovering risk and then assessing the level of the risk and whether or not their own, in this case, marketing program or marketing team can de-risk it fast if there is a risk. And anyone that's going to do due diligence on anything they're going to buy, whether it's researching a warranty for a new car or understanding just what they're in for, the more you do it, the more you uncover, the more you have to understand the implications. And for companies in the startup and scale up and acquisition space, the bigger you get, the more detail you need. So that data foundation, again, going back to the original comment, the more structured you are, the easier it is to deliver that due diligence.
Interesting. So it sounds like you said, when you make any big acquisition, you do some due diligence, you buy a car, you check under the hood, etc. So here, it's marketing that's the growth engine, along with sales. That's the growth engine for the company. So of course, they're going to look closely at marketing at this stage.
Because then in any B2B situation, and I know that we talked about the sales and marketing, it's getting murky. Like individual sales professionals are, I'd say from a profession, are experiencing a nice nuanced new wave appreciation for what they do and how they do it and the means and values of that role. And marketing as an individual salesperson is now becoming the standard, where they have their own social networks, they have their own ability to project their value to the market. And depending on where they are in their career or which company they're in, they can also influence their success. And where, if I'd say like where that blends itself over between the marketing and sales orgs is how you're positioning everything in market relative to the company and its value. I don't know of many companies that can exist without both running hand in hand. Like you can have a great sales team and a poor marketing team and you can eke it out. And you can have a great marketing team that generates tons of opportunity. And if you have a poor sales team, you fall flat. And you can still get something across the line, but it's never at the rate that you want. So when they're both firing together on all cylinders, that's when you see real success.
Yeah, I know you're a big proponent of that, Brent, and that actually is perhaps another topic we could talk about because I know you do have some innovative ideas about that front. But let's say you go ahead and IPO, and of course, the IPO itself makes for amazing marketing itself. You have the photos of your founder on the floor of the New York Stock Exchange. You have
Right.
so much buzz that comes out of that.
Yeah, absolutely. It's short lived because then people have expectations about how your stock price is going to go up. And then everything changes in the course of now you're subject to retail shareholders and the board makeup is very different. And maybe there's some familiar faces, but the objectives become very different. And your due diligence as far as ongoing planning and performance are now just at a different, but at that stage, all of the things that you've built over the course of years should now be paying dividends, no pun intended, to those new shareholders.
Fantastic. And of course, if you're a marketer, at one of these companies, now you have a chance to reap what you sow, either sell your stock or hold it for even more potential gains. But Brett, this was great. We've walked through the journey of a company starting out from a tiny startup all the way to getting on the floor of the New York Stock Exchange and celebrating their IPO, and how marketing is involved at each one of those stages, and how it interplays with a company's growth journey, and how it influences investors at each stage, and how it interplays with those investors. This is really great, Brent. I know we can probably talk more about this topic, but I know you got to run. So I really want to thank you for all the insights. I think it's a very unique topic. I don't think anyone's really done. And for anyone listening, if you want to explore the topic further with Brent, as you just heard, he has plenty of insights and experience in this area. Feel free to reach out to him on LinkedIn. And we're actually here in Toronto, the Toronto B2B marketing community is actually having in-person event later in the new year. And Brent's going to be a speaker at that, talking more about this topic. So if you'd like to meet up, come check that out. That will be, I believe, announced soon. Registrations will open soon. but this was a fascinating topic, a very interesting topic, I think. And we have structured it in three segments. So depending on what stage you're in, whether you're a founder or a marketer, you can tune into those particular segments or listen to the whole thing to get a view on the entire journey. But we'll wrap it up there, Brent. Thank you again, everyone. And any topic suggestions for future podcasts or anyone who wants to come on and speak about a particular topic, reach out to me. But Brent, thank you very much for coming on today. Real honored to have you on and excited to hear more of this at the next month's event.
Absolutely. And thank you for having me. And again, for anyone who's listening, this isn't a recipe. I'm sure there's lots of examples across each stage. There's lots of variable lessons to be learned and different stories. I'm happy to hear them all. So any comments or anyone wants to chime in, I'm happy to go tit for tat.
Fantastic. Thanks again, Brent. And thanks everyone for listening. Have a great rest of your day and we'll see you around.
Thank you, David.